Hello everyone, welcome to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. Let us understand today the difference between the capital receipt and the revenue receipt. See, capital receipts are generated by investment activities and financing activity. See, receipts means what? Income. So, investment and financing means in investment, whenever we sell any assets, fixed assets, from that we'll receive cash. So, investment and financing activities. So, whatever the funds we are raising by issuing the shares, it can be equity share or preference share. And revenue receipts are income generated through operating activities by sale or rendering services. So through these activities, whatever the revenue we have earned, it will be called as revenue receipts. The capital receipts will be our sources of income. Sources of income. And revenue receipts is purely an income generated for the activities. So here the capital receipts decreases the value of assets. Why it is decreases the value of asset is, now any one asset I am using for an economic benefit. From using that machinery only, I am producing the products. Now I need to sell that machinery. So it is decreasing the value of an asset. From 10 years you are using, that will be a main machinery helping for the manufacturing activities. So in that case, it is reducing your total asset value. So that is why decreasing the value of an asset, or increases the value of liability. You borrowed a loan from the bank. So when you borrow loan from bank, that is increasing your liabilities. And capital receipts is non-recurring in nature, but revenue receipts are recurring in nature. And revenue receipts, either it will increase or decrease the value of assets or liabilities. Okay, so capital receipts are shown under the balance sheet side. Revenue receipts are shown under income statement. Capital receipts are not used for the distribution as a profit. But revenue receipts can be used as a distributing as a profit, but only after deducting the revenue expenses. All the expenses we need to deduct. When how we are preparing income statement, from total income we'll take net revenue and we'll add other incomes. From that total income, whatever the expenses of different kinds of expenses, like it will be an indirect and direct expenses, both the expenses we are deducting from our total income. After that only the profit will be available for the appropriations. Okay, so capital receipts cannot be utilized for the creating a reserve fund also. At the end, after preparing your income statement, at the end certain percentage of your profit will be kept for the reserves, right? So only the revenue receipts we are utilizing for creating the reserves, the two only after deducting all the revenue expenses. Examples for capital receipts are loan taken or sale of fixed asset. Capital introduced for are the capital receipts. Amount received by sale of goods or rendering any services are the revenue receipts. I hope you all understood. Thank you for watching. Have a great day. If you are not yet subscribed, kindly subscribe their channel. Press bell icon to receive updates.